Did you know if you put $10,000 in the S&P 500 in 1943 and reinvested dividends, you'd have over $90 million today? That's nearly 9,000 times your money. This is the example Warren Buffett uses to justify his strategy.
The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund.
But here's what almost no one talks about. This simple strategy hides three risks, and if they hit you at the wrong time, they can quietly destroy your entire portfolio. And it all starts with how index funds are actually built. So picture the classic sales pitch. You buy an S&P 500 index fund, you now own a tiny slice of 500 big American companies. It's passive, it's diversified, and you just sit back and let America grow. That's the story. But the reality is, an index isn't a force of nature, it's a list, and that list is maintained by a committee. Yes, the S&P 500 is run by a group of people at a company called S&P Global. They have rules. To get in the club, a company needs a big enough market value. It needs to be profitable. Its stock needs to trade enough. Now here's where it gets weird. Your passive fund is shackled to this opaque process. Think about that. The index fund, which tells you to buy and hold, is often programmed to buy a stock only after it's already had a massive run-up. It's forced to buy high. But it's just a rule, right? How bad can it be? Well, for years, Tesla was revolutionizing the auto industry. By 2017, it was already the most valuable US car company. By the public rules, size, profitability, it was screaming to get into the S&P 500 club. But the committee waited and waited. They used discretion to keep it out for 3 more years. It wasn't until December 2020 that they finally opened the door. By the time every Vanguard, Fidelity, and BlackRock fund was forced to buy billions in Tesla stock, it had already sold over 740%. The index didn't just buy high, it bought at the peak after the historic gains. Imagine you're an investor who believes in the buy and hold the index philosophy. The single most disruptive car company of a generation goes on a historic tear and your fund misses all of it. Not because the company wasn't qualified, but because a committee decided to wait. But what about selling then? The committee's discretion works both ways. A struggling company can linger in the index long after it fails the rules, potentially dragging down your returns. Or it can be removed suddenly based on a judgment call, forcing a sale. It's not a predictable emotional robot. It's a system with human judgment in its gears. This is the first hidden truth. Your passive fund is making active decisions for you, driven by a committee's opaque timing. It's not just buying the market, it's buying what the committee decide is the market. This can force you to buy painfully late and sell unpredictably. But okay, maybe that's just the price for smooth long-term growth, right? Well, about that smooth long-term growth, let's talk about time. The biggest promise is compound growth. You put in money, you wait, and the line goes up and to the right. That's the chart they always show you. But what if your specific slice of time isn't that chart? We're told you can't lose over 20 years, that time in the market always wins. It's a comforting math-based idea. Let's look at real history, not theory. First, after the 1929 crash, if you just looked at the price of the S&P, it didn't sustainably get back to its high until 1954. That's 25 years. Next, the period from 1968 to 1982. 14 years where the market basically went nowhere. And the one you might remember, 2000 to 2013. If you invested at the peak of the dot-com boom in 2000, you didn't break even until 2013. Think about what that means for a real person. Let's say you were 50 years old in 2000. You'd been saving diligently, you had a nice portfolio, you were planning to retire at 65 in 2015. You followed the rule, you were in index funds. For the first 13 years of your plan, your initial lump sum made zero progress. It just bounced around the same value. All your growth had to come from new money you put in during that time. The compounding on your original nest egg was dead for over a decade. Now, the classic argument is, but that's just the price. What about dividends? And that's fair. If you reinvest the dividends, the picture gets better. You broke even years earlier. But the thing is, you still lived through it. The psychological weight of seeing no progress for over a decade is crushing. It's what makes people abandon the plan. And more importantly, if you were retired and spending that money, not reinvesting, those dividends were your income. The price stagnation alone could have doomed your portfolio if you were selling shares. When you start matters as much as how long you invest. The promise of you can't lose over 20 years is statistically true, but personally misleading. Your life doesn't happen in averages. It happens on one specific rocky path. And on some paths, the index gives you nothing but frustration for a very long time. But at least you're safe because you're diversified across 500 companies, right? Not exactly. Diversification is the only free lunch in investing. It's why index funds are so powerful. You're not betting on one company, you're betting on American business. That's the idea. Let's check what you actually own. The S&P 500 is market cap weighted. That's a fancy term meaning the bigger the company's stock market value, the bigger its slice of the index. You own more of the biggest companies. This makes sense, but it has a consequence. Over the last 15 years, a handful of giant tech companies have grown so huge they dominate the entire index. One third of your entire diversified S&P 500 fund is in just 10 companies. So are you buying 500 companies or are you mainly buying 7 mega cap tech stocks with 493 other companies along for the ride? If those 7 stocks have a bad year, your diversified fund is having a bad year, period. Now, this isn't necessarily bad. Those having great companies, but it's not what you're sold. You're sold on the safety of breath. You're told you're immune to any one company's failure, but you're highly exposed to the fate of a single sector and a tiny group of stocks within it. If the tech sector stumbles, your diversification vanishes. Warren Buffett is right. For most people, most of the time, a simple index fund is the winning move. But winning doesn't mean perfect. It doesn't mean risk-free. Your index fund is run by rules that can sell low and buy high. It can be stagnant for over a decade when you need the money most. It's probably way more concentrated in a few stocks than you realize. Knowing this doesn't mean you quit. It means you get intentional because sometimes the biggest gains come from staying in the game long after the rulebook says you're out.